None of VPM Partners, Bob Kendall, or any of its officers, directors, employees, other personnel, representatives, agents, or independent contractors is, in such capacities, a licensed financial advisor, a registered investment advisor, or a registered broker-dealer. None of VPM Partners or its personnel gives investment or financial advice or makes investment recommendations, nor are any of them in the business of effecting trades or directing client equity accounts or giving futures trading advice tailored to any particular client situation. Nothing contained in VPM Partners broadcasts, on its websites, or in its written materials constitutes a solicitation, recommendation, promotion, endorsement, or offer by others described above of any particular security, other investment product, transaction, or investment. Copyright 2014 VPM Partners. All rights reserved. Terms of use apply. Reproduction, adaptation, distribution, public display, exhibition for profit, or storage in any electronic storage media in whole or in part is prohibited under penalty of law.
Good morning, everyone. Summer's over, I guess. I guess technically not till the 21st, but kids are back in school, or most of them are getting there. The college kids are off and doing their thing. Anyway, a lot's going on, as always. I think this is going to be a pretty good week for the news, certainly, because we're looking at the employment situation again as that comes into focus. The first of the month fun that we always do. There's quite a bit, though. We're seeing it's interesting. If we get negative economic reports, market goes up. Mitch and I were just talking about this. But if it's positive, like 2 reports came out today, positive, and the market goes down. So we're down 5 handles now. The futures are 1 tick off of the lows of the session right now. And it's pretty typical. There's nobody who wants to own this thing over 2,000. And I saw a report that was on CNBC this morning, a news story, and Morgan Stanley now believes the S&P is going to 3,000. So we're getting really close. This reminds me of 2000, when the year 2000, when the dot-com boom was on, and everybody thought it was going to go up forever and ever and ever. And I'm not sure what will break this camel's back, but there is certainly a lot of signs. And I talked about some things in commentary that when we get these monthly reversals, I'll go through this in a minute, we get these big outside reversals like we had last month, and they end literally on the high of the month. They tend to be climactic, and this is actually a perfect setup because at the beginning of this month, we have now seen the market make a new high already from a historical high early this morning, and now it's reversed and negative. So depending on what goes on here, if we can't get above the this 06, 12 level, 2006 and 12, then this market's going to have a really good potential for declining. We're seeing in July, we saw a reverse down. We saw an outside reverse down. Then we saw an outside reverse up. And now maybe we'll see another reverse down. And this is the type of activity we're going to get. And I haven't seen the numbers this morning. We'll go through this live in just a few minutes. But Mitch, was there anything out there that I guess the reports that we had coming out were construction related or something this morning? Or?
Well, we had the construction spending. Consensus on that was 0.9%. The actual was positive 1.8%, so that was a nice beat on that. We also had the PMI manufacturing index come in pretty much right at consensus. Consensus was 57.8, the actual was 57.9. And then the ISM manufacturing index, the consensus on that was 56.8, the actual was 59. So that was a nice beat on that one too, and I think that was one of the highest it's been in some time.
Yeah, go ahead.
So those were the big numbers that came out today, and of course, as you mentioned, when the last economic report came out, the construction spending, the market just decided it had its day in the sun and decided to go back to bed or something. I don't know.
Yeah, it's interesting because the market is acting tired in a way, even though you could argue that an hour ago we made a new all-time high. So
we did.
So I guess that's not that tired, but the the way the patterns are unfolding, we're going to go through these in detail in a few minutes, are what continues to be interesting, especially as we continue to see all of the small cap and mid cap and different elements out there in style boxes as well starting to leg. And our typical Monday show and kicking off a new season here, we'll only be doing 2 shows this week. Next week will be Monday, Wednesday, and Thursday. And an announcement is we are going to have passwords to get in. You're going to have a ticket to get into the show. We'll be letting you know about that and where to find that both on the website, and we'll be emailing those of you that are officially invited to our little weekly parties that we're having here. And I know I've been talking about the TradeStation VPM Market Mind release, and should have the files today. They tell me I was supposed to have them Monday, but it was a holiday, so we're waiting for one final little piece. So I actually worked quite diligently on some of the manuals and some of the other stuff this weekend. So probably next week we'll have that out, and then we're going to start some shows just on how to utilize that. And the beauty of this thing that's coming out is that you're going to be able to do a couple things, and these are things that have been requested for years. And I'm not going to say it on air. I'm going to talk to Mitch off air because I had an idea this morning. I won't stick my foot in my mouth.
I appreciate that.
Yeah, before I say we could do something and we can't. But the ability inside a TradeStation, I know a lot of folks over the years, I mean over and over and over, I've heard they want to do like a percent trail stop. Well, you'll be able to do that with TradeStation. You can set percent trail, you can put dollar protections, you can do all kinds of stuff that these orders get signaled. And after I talk to Mitch, I'll tell you what I'd like to do with that stuff to make sure we can do with it. And most of the expert users are going to be going to be there from that. So anyway, the whole bottom line of what we're looking to do with this new project is to give the ability to look at any time increment. I had an advisor email me the other day, was talking about, sure, it would be nice if we could do monthly signals, especially with some of the annuities and some of those, to kind of slow down the entire, I guess, the whole trade stream that we get. And that will also be possible. And there's a lot of things that, as I started looking at some things this weekend and integrating some ideas with the output, being able to look at all these increments and getting them over into some of our other platforms. So we'll talk about that when it's an appropriate time. I won't. I've always been pretty good at saying things I shouldn't be saying, especially when it comes to software. And I think I've already done that pretty good with the Market Mind release. So I'm keeping my track record up pretty good. So those of you who know me for a while, I mean well, as I say. But sometimes I just I'm basing it on what people have told me, and that's the way that went. So nothing else. Let's go ahead and get started with the on the future side and start to get over there and start to look. You can see I brought up the first screen I brought up today is the 1 minute graph of the futures, and you can see the decline that we've had over here is, was pretty sharp. This is a 1 minute graph, but we're trading right now about 5 ticks or 125 points off of the lows right now. But there's still a lot of pressure on this market. There seems to be a substantial amount of selling above the market. And on the scale down below where I have my cursor, you can see there's kind of a wall of resistance. There's a lot of numbers. There's literally probably just within 100 points. There's probably 5,000 or 6,000 futures contracts for sale that are visible, that there are orders laying there, and there's more probably laying there with a click of a mouse. More will show up when things start to happen. So we've seen a pretty good decline. One of the things that happened going over to the cash chart here, we did see a high of 2006.12. And one day we're going to talk about one of these numbers, and it is going to be the high of this market. And we continue to see, from a technical viewpoint, we continue to see that these markets, the short-term PPM 1 is 21.30 plus 30.34 and 0.26. So we're still in a trend mode with the exception of the PPM1, is just slightly under trend, and it has been like that all last week. It's been the same scenario. The big number I haven't looked at yet, so we're going to look at this together, is when we go to the monthly graph. I want to see what's happening to that monthly PPM1, which is going to be, I think, reviewing here. I'm going to go ahead and put this up. We'll go ahead and look at that real quick here. And it's still hanging in there pretty good. I want to make sure one thing here, that we are updating like it's supposed to. I may not have done something, so bear with me just 1 second to make sure we've got the right numbers here. Apologize for doing this on. Yeah, you know what? It's not updating, so it will here in a second. So I was worried about that. I had to reboot this computer before the show, and I forgot to save these. So yeah, there we go. Now we're updating. PPM1 is 1.02, and what have I been talking about for weeks on this PPM1? I said this needs to drop below 1%. So we're pretty close. It won't take much downside movement to really trigger this thing into that mode. And what that is the first sign that there is a top beginning to form in this market on a long-term basis. And I know those who've been watching the show for the last several months, I've been rattling on about this for forever. It's just waiting for this event to happen. Well, we're very close to it, and I figured after when we started this new month that we would be close to that, and that was the expectation. So PPM2, let me bring that up, just move down here on the scale in the very bottom of this tab that I have here. It is 106, 157, and 102. So we're very close to seeing what's happening. Is PPM2 is tracking the 21-month moving average, and that is accelerating here. It is moving up faster than the PPM1 by a long shot now, by almost 30% difference. And that's going to cause a convergence of the two averages. And I'm going to take this off screen. I'm going to get off the screen so I can show you a couple things here from the standpoint of what's happening. When you see if I can move this over just a little bit here. You can see over here where my cursor is, and let me get the whiteboard out. That will make it even easier to track here. What you can see is when the momentum starts to go off, these two averages will converge and cross when there is a top of the market. Same thing happened over here, and you can see the PPM started to go down, and you'll see this converge. So one of the things that has happened here, this is that 1% number. So you can see when we get down below 1% there, that is where the break in the markets start to happen. And so in this case, this was 2007-8. We got this huge decline here that we marked out. At the moment, I'm not predicting this. There were some elements, as we all know, back early in July of 2007, when Bear Stearns announced their issues, that was the beginning of the crack in the armor that started the entire decline. We do not have those type of things coming out right now. That is not where we're at. We're not in a crisis mode. Now, one could argue that with all the geopolitical risk and Putin basically sticking his tongue out at the West and going into the Ukraine, and I guess somebody said it was out of context, but he did say that he could take over Kiev in a fortnight, in 2 weeks. And so that is, maybe he's telegraphing what he's doing, and while everybody's talking, he's acting. And this has been the case even going back to Crimea. But anyway, maybe there's some events here that could trigger. Mitch and I were talking offline here right before we came on. It's interesting. It's sort of like a union strike, if you will. The unions go out, the workers don't get paid, the union officials still get paid, and all the pain, supposedly the pain they're trying to inflict on the company, they have much deeper pockets, and it hurts the workers. Well, we're seeing the same thing in Europe. Germany and Europe is getting hammered by these sanctions, and it's hurting them. It appears, at least from what we can see, even though the ruble's dropping in price, and we've seen some downward movement in the Russian stock market indexes. Overall, no one's feeling that. Let's face it, when the market goes down, people are still eating and shopping to a point. It's not relative to that. And the currency movement may affect trade a little bit, but for the most part, since they've blocked everybody out, that becomes irrelevant as well. And the point is that these sanctions are causing stress in Europe right when Europe doesn't need the stress, and we're seeing lots of economic misses coming on in Europe. And people are arguing that the Ukraine doesn't affect U.S. profits, but ultimately it will, as some of these sanctions continue to take their toll on Germany and the major players in Europe. There's going to be some contagion at some point. It's just a matter how much and what becomes real there, and whether the crisis unwinds quickly or if it continues to go forward. And from that standpoint, but from a technical standpoint on these charts, we are starting to see the first signs that these events are going to happen. And I want to focus real quick here on, I'm going to draw a circle around this area up here. Yep, that was nice. Right as I got it, I accidentally clicked on it, something here. 1 second. I draw a circle around this area up here at the top, because this area right here was the '07 high. We had the same scenario over here in the 2000 high. And when I go over and show you the current, we're beginning that same pattern again, because this is the way a top of a market looks, just like this is how a bottom looks. And we can go through a couple of these things. I think it's important as we move through this particular sequence of the markets to understand the longer term charts and what's going on here, because that's what's been driving this market up when the whole time this underlying trend on a long-term basis has been bullish. I've talked about it over the last 2 years, how these long-term moving averages have been very robust, suggesting this market's going to keep going forward, and that there wasn't a likelihood of a collapse. If you recall going back to the outlook that I did in February of this year, the expectation was we were going to see a top in the market in the second quarter. Well, it's now moving into the fourth quarter, and we're finally getting close to that point where it's going to happen. And September has a record of being weak, but we saw the best August in 17 years, I believe. So maybe these seasonals don't matter, but we are starting to see, from my viewpoint on the technicals, let me take down this whiteboard here so we can go and look at the current markets now. You'll see this is the same area I was just looking at from the whiteboard standpoint. This is I'll circle it again. This was the top in '07. And as we came up, we're going to see this same formation happen here as the moving averages will converge and cross over. The 10 period will cross over through the 40, and then ultimately the 10 cuts through the 40, or the 10 will cross over to 21 that goes through the 40, that ultimately gets us into some kind of decline mode. And maybe it's a good thing to do today, to talk about what some of these scenarios are that are likely to happen from the standpoint of a retracement value. And the fact is that these moving averages in the place where they are right now, unless we start to see, and it won't be until October or November till we start to see the momentum on the 21 month start to dissipate as well. So if we get PPM1 on the monthly graph below 103, we'll start to see PPM2 start to decline. It will get under 1%, and all these will start to flatten out, and that will be the first signs that we're going to see the major top come into play. So those are the events that we're looking for. And remember, this, I always call this a super slow motion chart. So one of these bars takes a month. So what I just talked about here is like February or March of next year. So it's going to take several months, but that doesn't, the decline could be a 2 or 3 month decline into year end, and then we usually have a seasonal rally coming into January, but we'll have to see how all this stuff comes together. The key number, which I did not mention in commentary, I wrote it down last night and I meant to bring it up, and that's why I like having this platform with the show here to talk about. But the lows that we made last month, the 19, let me just bring that up and get the exact number. I think it's 1904 or something. It is exactly. It is 1904.78. A penetration of that level in the next 2 months, and doesn't have to happen this month, will be significant. The chances are, matter of fact, the 10-month moving average is 1887 right now. By the time we get into the next month, we're gonna see that move right into that 1890 level, 1900, and these are going to be the key points where the market will decline below the 10-month moving average. The PPM is likely to continue. It's almost, at this stage, it's almost impossible to get an acceleration to start to happen, because as you drop off the moving averages, the numbers that we're going to put on will have to be substantially higher, because you're looking at just going back 10 bars, we're at 1560. So the numbers that are coming on just from a moving average standpoint, it's going to be almost impossible to get an acceleration going again. So the bottom line is, this market has most likely started a formation of a major top, and it's going to take several months. And that doesn't mean that all bets are off, jump out of the market. You know, the sky's not falling. That's not what I'm saying. What I'm saying is this thing has begun, and it's going to take several months. The beauty, especially for those of you doing individual stock portfolios, there's still a lot of money out there on individual stock portfolios. On indexing standpoint, this is always the case with indexes. If we're going to go flat in the market, there's going to be no real returns here. And in fact, with the current positioning that we have, basis the global equity strategies, and even going through our database and seeing what you folks have built out of our 10,000 portfolios that are out there, that what you have built is also very similar to these things. There's a lot of common elements that have, from a ETF and even from a mutual fund standpoint, as far as style boxes and asset classes that are out there. So those strategies are going nowhere. Okay, there's going to be very moderate. You know, we look at global equity. I think we've just got SPY in there, and there's not a lot. There's not a lot to go with, and we can maybe touch on this stuff. And really, I think as we start this new month and we come out and start to dig back in and get to work, I think there's a lot of things to be paying attention to. And VPM's already got it under control from the standpoint of what's going on. And when I get done rattling on about this long-term chart, Mitch is going to come back on. We're going to go through the database. And just go through the database. So we'll probably spend another 10 or 15 minutes just talking about the database configuration, which is important, which is ultimately what's affecting your portfolios. And I think that'll be pretty important. I don't know where we'll end up after that, but I think those are pretty important things to understand as we start off this new month and come into start to build some expectations for the end of the year. Did I just say that? The end of the year? I think I did. Yeah, unbelievable, huh? So, but that's really what we're going to have to focus in on. So, anyway, so let's go ahead and bring Mitch back on here. And I don't think I gave you control, Mitch.
All right.
Let me just do something real quick here.
There we go.
Yeah. So I'm not sure I'm signed in. What's going on? Probably here we go. I am signed in probably to my account, but it's probably been too long. So when you go ahead.
Yeah, we'll start real quick. Just touching upon the stats that came in over the weekend. So again, going to research, going to the all stats page. We had a little bit of buying activity. When you look at the optimized models, even though we had 236 buys on the 1.2, 336 buys on the 3.2, when it comes to the actual optimized trade systems, we only had about 200 net buys across the board between mutual funds and stocks on the optimized models. So while we are seeing some more activity within the database, we are now up to 44.86% invested. We're still not seeing any sort of major turnaround when it comes to the overall database. I think we talked about it on Friday last week. The average portfolio within our system is about 50% invested. We are going to be looking at breaking that out between mutual funds and stocks. But I'd say it's pretty consistently the stock portfolios that are in that 50 to 60% invested range, whereas all the index-based portfolios, whether they're ETFs or mutual fund built portfolios, those are far more defensive, like the Global Equity Strategy 4, which is only 20% invested at this point with SPY. So for the most part, we're still taking a pretty defensive position. It's interesting watching how the market's been operating around this 2000 level. We've really gotten up to 2000 and just sort of stayed right there. We've been trading within a probably a 0.5% range, but really haven't gone anywhere from that afterwards.
Yeah, matter of fact, I think we closed at 2002 one day, 2012. We did 03 and change on Friday, and right now we're not close to it again. So.
Yeah, I think the big thing is just we're seeing a lack of conviction one way or the other, either on the buy side or the sell side at this level at this point. And it'll be interesting to see where we go from here. On the sector side, as you'll see, the most activity that we had this week was on the utility front. We had 8% purchase on utilities, and it was interesting to see that this also carried over on the mutual fund side of things as well. If we look at all the different sectors or investment categories on the mutual fund side, we'll go over to sector equity here. You'll see in the energy and the utility space is where we had the most activity across the board this week when it came to new entries. So when it comes to utilities, 45% of the utility mutual funds that we track had brand new buys this week. So obviously we've jumped into that. We're seeing that carry over on the stock side as well. And it appears that we got some pretty good pricing this morning on that because there's a healthy amount of pullback in that space at this open. So it looks like we got a pretty good pricing for those ETFs that are utilities and energies. And then on the mutual funds, we'll have to see where we close at today to see if it is still at a loss. But it's a great entry point for these sectors.
And don't forget, these are it's a defensive sector, so you're starting to see cash flow into some of these defensive areas. There's no conviction about growth or anything in this country right now. It's like, what is Janet Yellen and the gang going to do, and ECB and all the central banks, and I don't think they've got anything for us anymore. Certainly not at the level that they once were. So we'll have to see how this all unfolds.
Yeah, and it's today's a great example of where the good news is actually bad news, because it removes the interaction by these outside parties that have been so prevalent for the last few years. Because every time that we see that the economy itself is getting stronger, that means these people that have helped prop the economy out are more likely going to be stepping away from the market, and people don't like that. They like to feel like there's that net in place, and so it appears that every time that more and more of these positive announcements get made, while the market does creep up towards a new high, there isn't that conviction to start a brand new trend at that point to take off on the next leg of it.
Yeah, and the real world is the Fed doesn't want to be in this game anymore. They want out. They need to get this balance sheet. They understand the risk of the balance sheet that they have, and they also understand the risk of the deficits that are running as well. So we'll see how this all plays out in the end.
Yep. When you look at the globe at a glance, I thought it'd be good just to just zoom in here on Europe and Russia. Because we've talked quite a bit about it, but I just want to highlight what's taking place. You're seeing single to double digit declines across Europe right now, and all this activity with the Ukraine. And, Russia at this point, see that they're back down to about 16% at a loss for this year. And for all the activity by Europe when it comes to trying to sanction Russia as far as their interactions with Ukraine, it's only hindering their own markets as well. So I mean, they're getting cut both ways on this, both the actions that Russia's taking, and especially as we go into the colder months, the winter months here. It'll be interesting to see, now that Russia has a tighter grip on those oil and natural gas lines into Europe, to see how that's going to affect the markets, because all these sanctions that they keep trying to place on Russia is not going to do anything for them except further hamper their own economic growth.
Yeah, and real quick, the whole you were just going to Spain. Notice which is green. The worst of Europe is what's performing best right now, and you're looking at positive in Italy, and not only that, Greece is on the list on S&P as a potential for them to have a sovereign debt failure. Yet it's still out there, and Argentina is probably the tip of the iceberg. And there's several countries out there, none of them of substantial, I guess, substantial economies that could roll over the planet. But there's certainly a lot of things out there. But it's interesting that Spain and Italy are doing so well.
Right. Well, and this is just an important frame of context to bring out, because a lot of advisors, they use these MPT based portfolios when it comes to constructing them, getting these international components in it. And we've talked about this time and time again. We talked about this last year. We're going to continue talking about it this year. When we bring in these outside elements, these markets that are not part of our domestic market, that's going to further pull down the overall performance. And it's easy to look at something like the S&P 500, all these large cap companies that are around 8% positive for the year. But people forget, these other components that they have within their portfolios, whether they're commodities or whether they're these international components that aren't performing nearly as well. They're fully further dragging down performance of the portfolio, and we're just seeing that more and more. This week, I thought it was interesting.
Well, they're probably not dragging it down a lot because we're out of them. Most of these we don't own. So
I'm talking about the as far as the global marketplace. Just trying to provide some context as to why these portfolios are so defensive. But you're right. Yeah, we're almost completely out of these. The Global Equity 4, the only position that we own in that right now is SPY, and that's why. Yeah. And then just jumping over here, the S&P 500 pacing, you see that only about 46% of the components of the actual S&P 500 are keeping up with the overall average or exceeding it. The majority, 54%, are either performing below the average or significantly below it in this case. So we're seeing, as we've talked about before, where we see less and less participation up at the tops, bringing the index forward, but the overall constituents of this list are not doing anything to show signs of strength in it. And again, looking at the style box here, you see that we're still at the best performer is this large cap growth style box. And if you don't have solidly large cap positions in it, you're not seeing the type of performance that we're seeing on the S&P 500, because everything else is performing much weaker, as evidenced by the small and mid cap style boxes. And so that's pretty much a nice cruise through the database, the dashboards right now.
And now the trade impact charts get updated this week as well. Today, okay.
Yeah, at the end of the day today, they'll be updated. So.
Yeah, and just going to take back for a second control here, but these trade impact charts, they'll be updated today. But these are real, I think, important to understand and spend some time with. I always look at the amount of views on here, and I'm like, you guys are missing it. There's some great presentation tools. Great way to talk about the process and what to go on there. So when those are updated, we'll make sure you know that, and we'll go on from there. So
yeah, the trade impact is such a key concept. I mean, we brought this over into the fact sheets this last month. So we've revamped our process to be able to produce these fact sheets, and I think it's such an enormous benefit to your practice to be able to use these type of materials to present the overall concept, so people can see what type of activity is taking place and what this activity does for your portfolio. So yeah, just jump down to July.
I'm going to go ahead and we'll bring up which one, all weather. I guess that's easy. It's right there.
Yeah, go ahead and pull that one up. And we've restructured how we do the color coding and everything. So, if you wanted to have these run on your strategies, we could do that as well for your own portfolios with your own logo, with your own branding on it, and be able to show the impact that's being generated. It's on the last page there.
Yeah. So
and you can see how it is each of these trades reflect the gains or losses on your strategy, as well as what the best trades and worst trades were when it comes to the overall performance of your portfolio.
Yeah, and just as Mitch was talking about here, these things have been revamped, and we've got a lot of different, I guess, views of your strategy here and what's going on. But anyway, these are important to understand, because these are the stats and how the process is continuing to work. And I believe that the stair-stepping equity, well, we've seen some of these strategies look like they're, I guess, they're not performing with the S&P, but guess what? This isn't the S&P. This is a style box strategy, and it's got a large, mid, and small. So 60% of what it does is small and mid and two different style boxes. So this thing is not going to present itself like the S&P 500. It's a much different strategy, because you've got large, mid, and small value and growth strategies, and including in this strategy you have an embedded bond. So you have a intermediate bond and a short-term bond as well. So this is it's not apples and apples. You've got apples and turnips.
Apples and avocados, as I often say.
So they're not just the same, but do want to feature these things, because there's a lot of stuff out there that we want to make sure that you guys are seeing these strategies. And for every one of our premieres, there is a strategy. These things are out there, these sheets, and we will be talking to you more and more about as we start to get back into our full season here and back into doing exactly talking about process warriors and all the other elements of the practice that we're going to be able to impact. These are the things that you definitely want to have a handle on. And in some cases, these aren't usable if you're within a network, and from a broker-dealer standpoint. Some they can be approved. There's a lot of elements there, and we've worked through a lot of these with different advisory firms. So we certainly can help you, and depending on your broker-dealer, we know most of them pretty well and what their criteria is for using these. But for sure, they're great for non-handout using for your presentation. And I know we've talked about this before. Some of you just like a good old fancy napkin and a piece of paper, but this certainly gives you a very professional view and look. So anyway, that's what's going on there. So we'll go back to some other charts. One of the things that I didn't cover, and I want to go back to the technicals real quick. And as you can see, the database has, just to kind of summarize that Mitch was talking about, that we're about 50% in cash right now. And as I continue to emphasize, this is not 2008. We're not in a crisis. We're not in any type of financial meltdown. So this is pretty much what a corrective phase, what a protect looks like right now. And it may get a little, I guess maybe we'll move a little more to cash, but typically somewhere between 50 and 60% cash is about where most of these positions go during a period like this. So there's not going to be 100% in cash. For instance, even in the global equity strategy, Mitch was mentioning Global Equity 4, we're 20% invested, but we own the only thing that's trending, which is the S&P 500. And the way it's acting right now, we're now down 613. We're pretty close to a pivot number, which is 95.80 on the day. We take that out, then we're starting to get a little more serious about doing some selling in here. And as I said, by protecting your portfolios being 50%, it's going to make a lot of sense to you when you turn the clock over. I think I mentioned a couple of weeks ago I was in an advisor's office, and I know quite a few of the clients. I've spoken in front of the group a lot, and one of the customers had confronted me about, hey, we're out of the market's going up, but when you look at the strategies that we're in, not everything that was in that strategy, A, wasn't 100% in cash, B, the fact that it sold anything, the average client and sometimes even the average advisor feels like they're being left behind. When you look at these assets, while some of them have rebounded, they're not making new highs, they're not in a new trend. And being a trend follower and doing what we're doing, we're much better off. It's the whole philosophy of VPM is that I'd rather be in cash. If the market's not trending with high probabilities for them to continue, I'd rather be out. So the only market to this moment that has those type of probabilities is the S&P 500, IJR and MDY and all those, EFA, EEM, you name it. These are not markets that you want to be involved in right now. And some of them have rebounded, and there would be some residual benefit from an equity standpoint from a comeback, but in the end, it's too risky to own those if these things roll over completely. So when the S&P starts leading, as that's been my big thesis for a while, here is the international charts. This is on the left-hand side is EFA, and that relative how the S&P, it's actually upticked a very little bit this morning, and on the other side is EEM. It's also upticked about the same. So this, I've been harping about this as well. When these spreads turn around, this market is done. I mean, completely done. Right now, they haven't turned around. There's no signs. There's a little uptick. It's zigzagged and sawtooth all the way down. So we're not at a point where we're seeing those things happening, but this will probably be the final confirmation that these things are happening at the end. One of the other areas that we've been watching here, this is the 24-hour futures. You can see the 60-minute chart has topped out pretty good. Earlier this morning we had a high coming in, and that's been the high. It's going to roll us over till almost tomorrow's opening before we're probably going to see a low of this pattern. The 5-minute chart, the cycles seem to be, sometimes this thing will get out of sync. We'll see if it comes back in. There was a potential low right here, but it looks like it was a continuation cycle. So we're still under pressure here as the market's printing down around its low of the day. Last but not least, we're seeing this chart here. We're seeing the VIX back up at 1254. We talked about volatility continuing to be fairly low, which really sets the tone for this market to start to move lower again. And we're, if nothing else, locked in a giant range. But you can clearly see on a weekly basis this where my cursor is right now, there is a flattening of the 10-week moving average. It's not in trend mode right now, and we're likely to decline back down toward this 21, which is the 1938 level, and I think there's some Fibonacci numbers between 54 and 48. So those are probably the target zone from that standpoint. And on the short-term basis, we're probably going to form what I call a diamond top here, depending on how the next couple of days come in. We'll be able to see what this is about as well. So overall, as I said, the markets are continuing to be in a beginnings of a topping phase here. And this market that we watched, here's a daily chart I just put up here. It's ran from 1904 all the way to 2006, and now we're starting to see the momentum. We're at 0.12, 0.17, and 0.02. So none of the trend stats that we need to see to make this short-term chart positive are there. and I can see we're pushing now down to 718 on the S&P. If we bounce over real quick over to the futures, you'll see we are 2 ticks off the low of the session right now, and looking to challenge this 95.80 number. It's pretty close to it. It'll only take a couple more clicks. On the futures are on the low right now. You can see on the far left, they're trading on low. There's 406 bid by 247. So we'll see if they get through this. They'll probably run it down fairly quickly once we print through this 95.80 level. There for the day, there's nothing else. You have to go to the weekly stats, and you're not going to find any reasonable support until 1988. 1988.90 is the next level, and the realities of that is that we're probably between 88.90 and 86.60 will put us into S1 on the monthly all of a sudden, and if we get through those levels, the next level is not all the way down to this 1967 to 1949 level. So all of a sudden we're printing down. We just made a new low. We're right at that number, 95.80 right now, and the futures just sold off about another 100 points. So looks like we're going to go through it. It's 89. So it's happening out there right now. So this is the extreme projection for today was 1995.80, and we've maintained that. It's something I haven't talked about, but we've been maintaining underneath the 3-day VPM rangefinder has been below the 10 handle for a while, and it was around 890 something today. So we're looking at this thing starting to expand, and typically when the volatility expands, it's on the downside. So there's a fair amount of selling. We did bounce a little bit right off of this number here. Just looking at this, doing a real-time show like this, you have the opportunity to have some of these. So the low was 95.82. So the extreme of the day was 95.80. So we're 2 cents, and now we're 96.14. So we're trying to bounce off of that level. So we held it for the moment anyway. So we've got about 12 minutes to go here in the show, and Mitch, I don't know what you had focused for talking about some stocks today and looking at some other elements here. Maybe we can go into that zone at the moment.
Yeah, I thought it'd be good. We've talked about what's actually taking place in some advisor strategies, and you and I spent a decent amount of time with an advisor recently on some various different sector ETFs. And since we had this brand new buying taking place in the utilities, I thought it'd be good to start there with the AlphaDex Utilities ETF. Ticker with that is FXU, and that's using the 3.2 weekly trade system.
Yeah, this is actually just before I even put the trade system on here. This is pretty classic where it went down, did not print a new high. You've got a reversal over here on the 4th of July, which was what I was talking about when we were going through the indices a minute ago, is that we saw a reversal down in July, a reversal up in August, and now we're working already on the potential for a reversal down. Of course, to get to reversal down, we have to go through 1904.78, I think was the number we were talking about earlier. But let me bring up the system here, see if we can do that. 3.2, right?
3.2 weekly, yep. So as you can see, we had a brand new buy this morning on it.
Yeah, so there's a buy there. Of course, this particular one was short before. I won't worry about changing that right now. This has long and shorts available. And that's the other thing that is available on the TradeStation version is short sales. So there's a lot more dynamics because of the environment that we can generate on a real-time basis. So this is the weekly. We do have a new buy here, as Mitch pointed out, and it is sitting here on support right now. Matter of fact, it shows that it covered the short at 23.53, bought it at 23.63 on this. Our database that we have sometimes will slightly vary in case you wonder why. I don't know until we're end of day, so we'll go and collect the data tonight, run all the models and update them, so you'll see the fill on this if you bring up this symbol for tomorrow on version 3.2. So anyway, the momentum is pretty flat, although 2643 on ppm2. I'll bring that up here, and you'll see that the oh, you know what? These indexes are not set to update, so I won't worry about that right now. But I'll read them off the screen. 04.04 on ppm1, 0.26 on the ppm2, and 0.34. So both the 21 and 40 period moving averages are actually in a trend mode, and those targets there, those numbers are 2081 and 2056. They're very close to each other, but let's see if I got the right numbers here. Let's try that again. 2299 and 2201 are the values for those two moving averages. So those are going to represent substantial support. Where 2325, we're about a buck off of that low, and typically what we're going to see is now what is this sector of, Mitch?
This is utilities.
Utilities, okay. Yeah, so here we go again, another defensive mode coming out into the market. So that's pretty typical, I guess, on what's happening here.
Yeah, in that same vein, also on the 3.2 weekly is the ticker FXN. That's the Energy Alphadex. We're currently flat this security. So we sold out, let me see what day we sold out of this. On the 4th of last month.
Okay.
So we made a nice 13% gain on that, and then exited out of it.
Okay. So yeah, from looking at this thing on a technical basis, you can see we're minus 0.23, we're plus 4.5, we're right on support numbers right now, and plus 3.7 on ppm 2 and 3. So we're still got a trend mode, although the short term is right at trend down. So this is actually a good thing to talk about here, is that the convergence, you can see where the moving averages were spread out, and now you're seeing the 10 converge, where you see it's actually declining toward the 21 period moving average, and we'll see a crossover probably next week, I would suspect. We're declining 0.25% per week on the ppm1, while we're going up just about 0.5% on ppm2. So those things are on a collision course, and once that happens, that will start to show the crossover, which will probably lead us down, at least testing this 40 period moving average, which is currently, make sure I got the right number here, yeah, 2663 on the downside, and we're 2852. So this is going to be a convergence, and the thing that will trigger this will be that crossover will signal the move down to the 40, and then if the 40 holds, then we'll be able to see exactly what is going on from the standpoint of the trend at that point. So this thing is a work in progress, we'll say.
Sounds good. All right, next up on my list is ticker FXR. This is the industrials sector, and we're currently flat this position. We sold out of this one also on the 4th of August.
Okay.
Already thinking about next month. And that one, we took a nice gain on that one. We locked in a gain of 45.75%.
Yeah. And this was what sector again?
Industrials.
Industrials, okay. Yeah, there's industrial producer. Okay. So the same thing, July, actually June had a reversal earlier than the July. Let me bring up whiteboard just for a second here so you can see these events. You got the reversal down here, and then you've got the stair stepping down. Just as I was discussing before, it tested the 40 period moving average. It's moved off of this back above the averages, and now what you see down below here, I think I'm in the way, so let me get Mitch and I out of the way to finish this. On the left-hand side, you see ppm1 is 0.03, 0.19, 0.29. So the 40-period moving average that we bounced off of still is in trend mode above 0.25, suggesting that we're going to hold that value. And there's on this page also I have the Fibonacci price objectives that you can see there. And bringing that up just real quick, you'll see those numbers are also being the high target is 31 to 33. The old high there on the charts was 31.26, so it's projecting a minimum to go back and retest that pattern that's out there, and that pattern's been intact since back in around, looks like June 23rd is when these numbers were projected out of this range. So what we'll do here is we'll go back and do one final review as we're getting close to the end of the show, talk about where the markets are from the standpoint of the indexes, and bring this up full screen here. You can see we are 96.63. The low has been 95.82, so we came in 2 cents at the extreme. There probably, we'll take a look at the futures here real quick just to see if it looks like if there's going to be a retest. There's still a lot of pretty heavy pressure here, and chances are we'll probably see a retest of this little low that we had here. But it could hold, and the key number for today, from my viewpoint, is we're going to need to close under that 95.80 to really signal anything serious from a standpoint of a reversal. But we are seeing, after printing the 2006, going back to that chart there, 2006.12, we've now declined 11 handles off of that. And because the ranges have been so narrow in the last several days, that seems like a big move. Literally, most big days are 20 to 25 handles wide. So what would have to happen today, we'd have to trade all the way down to the 85 number, which would put us on the somewhere between the S2 number on the weekly and the S1 number on the monthly, which is 1986.60 and then 1988.90. That would be your next downside target if we can get through these lows of the day. That may not happen until tomorrow. There may be further follow through, and the close is going to tell us a lot. What we've seen is the bargain hunters and the rally back. It doesn't look like there's a lot of rally back in this market right now. There may be some, and the key numbers going back is going to be the 97.60 is going to be a pretty significant number on the upside now, and then you won't see anything again until 99.60 and 2001.60 would be the number. All of those numbers keep us negative on the day. There was an expectation if we could hold this 95.80 that we would finish positive, but it doesn't look like that's how the markets are setting up at this time. So in closing, I expect to see this thing stay under pressure for the rest of the session. Close under 97, where's the number? 97.60. It's going to be pretty negative leading until tomorrow. Of course, as I talked about in commentary, we've got a lot of news coming out that is going to be impactful, I believe, this week. This could end up to be a fairly emotional week as everybody supposedly comes back to work. I suspect everybody's back. We'll see. I don't know. We still were getting a lot of emails that most of you are out of town, but that should start to change pretty quickly here. So in the last minute, Mitch, we got anything out there?
No, I guess to conclude it, watch for the updated Premier fact sheets for today, as well as the trade impact chart. All those will be done at market close today. And if you want more information on the fact sheets for your own portfolios, just contact us at support@VPM Partners.
All right. Thanks a lot, folks. We will see you on Friday. Since it's a short week, we'll come back on Friday, and next week we'll hit a lot of stuff. Hopefully the TradeStation Market Mind presentations. We'll probably do at least one. Process Warriors, we'll kick that show back in, and then we'll start to go from there. So have a great day. We'll talk to you on Friday, and enjoy the downside. See ya.